Hey there, everybody. Welcome to my channel. My name is Ryan Schul, and I do all kinds of data science experiments, deep learning, artificial intelligence, machine learning, and things like this. So in today's topic, I want to talk about descriptive, diagnostic, prescriptive, and predictive types of statistics. So what is this exactly? Descriptive basically summarizes something, right? Diagnostic looks at what caused something or what happened. Predictive looks at forecasting into the future. Think about predicting the weather, right? Forecasting into the future. And prescriptive is more about suggesting a strategy, something like a rebalancing of an investment portfolio. So there's so many applications for this. I am going to just focus on the financial topics today, and that's where we're going to go with this, okay? Because finance is my background. I got my MBA in finance from Johns Hopkins University back in 2003, so it's been a little while, about 22 years, and that's what I know best. But again, keep an open mind when you're watching the video, when you're trying to do this stuff yourself. There are so many applications in the manufacturing area, education, government, consulting. There's so many applications for this. This is just financial. I can't cover everything. That would be impossible. That would take me the rest of my natural life. I can't do that. So I'm just going to focus on finance for this discussion, okay? And this statistical type, again, can be descriptive, diagnostic, predictive, and prescriptive. So we're going to look at what happened, why did it happen, what will happen next, and what should you do when that thing happens. So let me import some data from Yahoo Finance. If you've seen some of my other videos, you know I use Yahoo Finance a lot. They have an API that's very dynamic, interactive, totally free, and it delivers a lot of very useful information. So here we have historical stock prices for different tickers. We have Apple, Disney, Home Depot. This is Visa, Procter & Gamble, Walmart, and Nike, and Disney, and so on and so forth, right? So this is pretty straightforward. So this descriptive, again, is looking at describing what happened. So what happened here? We're looking at the percentage change in these stocks, right? These are the returns of the stocks, and I'm just displaying the output right here. That's descriptive analytics, okay? And another example would be a rolling mean. So what happened? What happened in the past? Rolling mean, we are looking at Control-Enter to refresh this. Data rolling with a window of 30 days. So we're looking at a lag of 30 days. We're going 30 days back and taking the mean of these data points, right? So that is describing what happened right here. And then we're also looking at the standard deviation. So here we have the rolling mean, okay? Dot mean is the function right here for this data set, and dot standard is the standard deviation. So the mean is the average. What happened on average, right? You can have spikes up and down, back and forth, a lot of volatility in the market. But what's the mean? What's the average return? This function gives us the mean, dot mean, and standard deviation is the volatility. So the up and down, the bouncing, the changing of the stock prices over time, okay? So let's look at another example here and plot it just so we can see visually what's happening. We're taking the returns, looking at the percentage change, right? And the cumulative return, which is the summation, or the grouping of everything, the summation of everything over time, the cumulative product, right? So we're using this function, cumulative product, and plotting the return. So right here we can see, if I put the mouse over it, looks like probably Microsoft. These charts are very interactive and dynamic. So if I click on and click off, it disappears or reappears. So that's Microsoft. They had the biggest gain over this period. And what were we going back? 120. So 10 years. So 10 years, Microsoft performed the best. So that's descriptive analytics for describing what happened, right? So it's up quite a bit, actually, like 10 times. So this is a 10 time. This is about 8 times. And some of these are like 6 and 4 times returns, right? So let's look at the running maximum. This, again, is a cumulative max function, okay? And we're looking at the the different tickers that we have in the sample here, and then the returns of each one. Okay, so again, describing what happens with the data. So the skewness shows us, skewness or kurtosis shows us the change over time. Is it a fat tail? Is it a flat tail? Fat can be, it kind of goes down over time and then jumps up right at the end. That's a lot of volatility risk. You see this sometimes with different companies. Long-term capital management had that problem. They went out of business. Bear Stearns, Lehman Brothers had the same issue. They went out of business, right, because of the fatness of the skewness of the tail. So most of the time, it's normal. You have normal probability distribution. Sometimes it's skewed to the left. Sometimes it's skewed to the right. And then sometimes you have a fat tail, and those fat tails can literally kill your business, right? If you have a high volatility situation and a lot of risk exposure at one point in time, just 1 week, maybe 2 weeks, your business is gone. It's gone, right? So you have to protect yourself. You have to manage your risk accordingly, right? So skewness is asymmetry of the distribution of returns. Right skewed is a long tail off to the right. Left skewed is a long tail off to the left, right? Normal is mesokurtic. I think these are based on Greek terms. I think this is a Greek term. You can Google it, mesokurtic. You have leptokurtic and lidokurtic. I remember learning about this in school. Didn't make sense to me totally back then. It does make sense to me now, but these are terms that's used in the industry, right? So I think it's a Greek word. So anyways, that's what I have in my notes. So that's how the variability or the change occurs over time. So let's look at the next example here. So Control Enter to run the cell. And we have autocorrelation can be both descriptive and diagnostic, right? So descriptive, remember, describes what happens, and diagnostic, you're trying to understand what happens, right? So what happens? Descriptive, what happens? Autocorrelation can be descriptive when you are summarizing something or describing a pattern. So this actually can fall under a couple different areas, or can go into a couple different buckets, right? So diagnostic is more, why did it happen? So describing something, well, what happened? If you tell your boss, hey, something happened over here, let me describe to you what happened. If you're talking about diagnostics, like, why did that happen? Why did something occur? Why did it happen? Why did we get that result? Why did we have that outcome, right? So that's diagnostic statistics, okay? And we see that over here with the volatility of the stocks and the most volatile and the least volatile stocks, okay? So let's move into the second concept here. Remember, we're describing descriptive, diagnostic, prescriptive, and predictive. This is the second example here, diagnostic stocks. So now we're looking at a correlation of all the stocks that we picked in our universe over here. And again, this is just one example, right? Based on the inputs that we set over here. This can be any ticker that you want, right? So you can change this. You can manage this to be anything you want. You pick different stocks. And again, this whole concept of descriptive, diagnostic, prescriptive, and predictive is really up to you. Like, what do you want to do? Keep an open mind, be flexible, be changeable, and be scalable, right? And keep an open mind about what you're trying to do. This is just one example based on financial data, right? So I think I lost my memory here. Oh, here it goes. Okay. So we have, where are we? Correlations, right? Correlations. So these are the correlations of the stock. Sorry, we got a little bit out of order here. So let me refresh the cell. We'll Control Enter to refresh. So here we see the correlations, and this is diagnostic again. So we see all the correlations here. A higher correlation means these two events move together, or these two stocks move together. So Apple and Microsoft are pretty highly correlated. 0.68, higher is better, right? 0.10, Microsoft and Apple move together. These are two tech stocks. They do software development, probably some hardware development. Microsoft has the Xbox and Apple has the iPhone, right? So it's software and hardware both, and the stock prices tend to move together. Some of these are not correlated very, very much at all, like Johnson & Johnson and Apple have only 0.34 correlation. Disney and Apple have only 0.34 correlation, right? So you see everything on the diagonal is perfectly correlated because that's correlated to itself. And anything on the vertical or horizontal is actually like the true correlation. I could almost ignore like the diagonal. I already know that that's correlated, right? I'm more interested in the vertical and the horizontal, and you can see everything is a mirror image of that. So here's Disney, and Apple. So here's Disney. And I like these Plotly charts because you can zoom in, you can see all the details, then you double click and it zooms out to the original, right? So autocorrelation is partial correlation. Let me Control Enter to refresh the cell. So autocorrelation measures anything relative to the other stocks. So how correlated is this stock price, this historical stock price, to other stock prices over time? That's what we're looking at here. So volatility clustering is another example here. And we are looking at the volatility of the stock prices over time. And you saw a huge jump up over here after COVID. So basically, this was a lot of day traders trading on the Robinhood application on their phones and staying home. People were working from home, not necessarily even working, just working from home, whatever that means. And they're staying home and day trading and doing whatever they wanted to do after the COVID virus hit. And that was a crazy thing. I have another video about that. That was the craziest thing I've ever seen. The entire planet shut down for a cold. People got a cold and they shut down Earth for that. Okay. Still doesn't make sense. Okay. I'm not going to talk about that anymore. Shut down planet Earth for cold. People get colds all the time. I'm sorry. Don't shut down the planet for that. So here we have rolling correlations. Okay. So let me do a Control Enter on this cell. And you can see Apple versus Microsoft. Okay. And you see the 60-day correlation over time. And again, I like these Plotly charts. You can zoom in, you can see all kinds of details. You put the mouse over it and the bubble pops up and shows you what's going on behind the chart. So here is beta versus the market. So if you know finance, great. If you don't know, I'll tell you right now, beta is a correlation of that stock to the stock market, the S&P 500, basically. So if the S&P moves 1% or 2%, that stock will move that same multiple times. So if the S&P moves up 1%, this will move up 2.7%. If the S&P moves up 20, or keep it simple, 10%, this moves up 27%. That would be like, if it moves up 20%, that would be a big bump in the S&P. That would move up, I think 54% or whatever that is. So this has a lower beta, lower volatility to the market. If the market moves down 1%, this moves down 60% of that 1%. If the market moves up 10%, this will move up 6%. Okay, and that's what that means. That's the beta. And then you have the event detective and anomaly diagnosis and the results right here, right? So you're looking at the returns. Is it greater than the mean, or the returns is greater than the standard deviation? Okay, so yeah, it does get a little bit complex, guys, but I'm trying to just explain like descriptive, diagnostic, prescriptive, and predictive. So stick with it until the end. I think you'll get a lot out of this. So this is seasonality diagnosis. So again, we're looking at the month of the stock returns, and again, getting the returns and grouping by the month and the mean average of the returns for the month. Okay, and then we have the rolling mean. So this is the change over time. We're looking at the changing over time with a 90-day window. So we're going back in time 90 days. And again, looking at the average, the dot mean function tells me this is an average right here. So I'm going to go ahead and refresh that cell. Control Enter to refresh. We'll get the rolling means, and all those rolling means looking back with a 30-day lag plotted. Okay, we're going to get the plot down here. This is what that looks like, okay, for Apple. So a lot of volatility up and down, a lot of changing there. And then we get now we're moving on to prescriptive statistics, right? So again, descriptive, diagnostic, Prescriptive is the third, and predictive is the fourth one. We're looking at risk return trade-offs to build suggested portfolio. Okay, that's what we're looking at here. So we're looking at, again, the mean returns of the portfolio and then which stocks are performing the best. Okay, so we see all the average returns, 0.000974, 0.000618. These are the mean returns for the whole portfolio. Minimum variance portfolio here. So we're getting into more like portfolio management, asset management, wealth management types of discussions here. So again, remember, it's all finance. I'm trying to talk about 4 different statistical analyses here: descriptive, diagnostic, prescriptive, and predictive. And I'm trying to give an example of each one. So here we're looking at portfolio management and the Sharpe ratio of the portfolio. So this is the risk-adjusted return of the portfolio. So I have a couple of videos about this if you want to go deeper into this. It's very, very fascinating, very interesting. How you pick the best stocks for your investment portfolio, for your wealth management, for your investment analysis, based on the deviation of the stock returns over time. So those are the volatilities, the ups and downs, the standard deviations, and then the ability of the stock to appreciate in price. So if there's a lot of volatility and it's choppy, it's up and down a lot, and it's depreciating, you don't want to invest in that stock, right? You want to avoid that type of opportunity, or not opportunity. But if it's bouncing around a little bit and it's mostly up and it's pretty consistent, that's the stock that you want to invest in, right? So that's what the Sharpe ratio helps us to understand. This is the change in the stock price over time divided by the volatility or the riskiness or the choppiness of those stock price movements. That's what that is. So we can go ahead and plot the efficient frontier. So the efficient frontier of the stock is where you want to be invested in. And this shows you, based on the historical time series average, remember we're going back 10 years of all these stocks, the higher Sharpe ratio is better, but then you have more volatility too. So higher is better over here. You're getting 1.4 times your return. This is expected return, 1.4. If you invest $100, you make $140, right? If you invest in 100,000, you make 140,000. That's what that is. But again, look at the horizontal axis, more volatility. So down here is a lot less return, less volatility, and is always a trade-off, right? More risk, more potential return, but not guaranteed return by any means. Nothing in finance is guaranteed. More volatility, more potential returns, but more potential risk too, right? So you have to balance the risk return and see what your appetite for risk is. You have a higher appetite for risk and you're fine with that, or you want to sleep well at night, right? Do you want to eat well? You want to eat steak dinners, which is expensive, every single night, or do you want to sleep well? You rest like I don't know, like an angel. You rest like an angel, but you have no returns on your portfolio, right? So you have to pick. Sorry, you have to pick between those two extremes: high risk, high potential return; low risk, low return, and that's pretty much guaranteed, right? As you go out on the risk scale, that's less guaranteed. So this is the maximum Sharpe. This is the best place to be on the entire portfolio spectrum. You have a portfolio value of 2.6, expected return 0.50. So you invest 100,000, you make 50,000 on your investment. That is the best place to be based on all the stocks that we picked initially, right? So the tail risk prescription, let me refresh the cell here. You have 95% confidence that nothing bad will happen today. Now, again, there's extreme events. I told you about Bear Stearns. I told you about Lehman Brothers. Long-term capital management went belly up, right? So there's extreme events that can happen, but 95% of the time, you're confident that you're not going to have a bad day, and you cannot lose more than 2.7% in a single day for Apple. Where's Apple? 2.7%, and Microsoft is 2.6%. You can't lose more than 2.6% of your portfolio in a single day with 95% certainty. But again, it's 5%. There could be a big event. Those are those fat tails I told you about. Those are those black swan events that can come up and grab you, and destroy your portfolio. Bernie Madoff, that's an example of that. That's about black swan, right? So watch out for those things. So there's a rebalancing strategy, monthly, quarterly, triggerly base. I have some notes here. You can check that out. I'm not necessarily doing that. If you want to do that, that's totally up to you. That's totally fine. So the fourth point on the topic today is predictive statistics, right? So we talked about descriptive, diagnostic, prescriptive, predictive. So prediction, what's going to happen next? Think about the weather. Turn on the news, right? What is the forecast for the weather? That's a predictive event. What's going to happen next in the stock market? That's a predictive event. What's going to happen with your sales for your customers, with the demand for your product? That is a predictive event, right? So we can use a time series analysis to understand what is going to happen next from a predictive standpoint. Okay, so we have this prediction for Apple. These are the predictive prices into the future, or the predictive change in the price, right? That's not the actual price. That's a change in the price. So let's move on to the next thing right here. We have Prophet. This was put out by Facebook. I have several videos about Prophet. So that's a very cool, very interesting. This is probably my personal favorite of all the time series tools. So Apple, we have the just two variables. It's very simple, very straightforward. We have the time right here, DS is the time, and the Y hat is the value that you're trying to predict. And again, we're trying to predict the future change or the appreciation or the depreciation in the stock price. So we have that, and we can do more predictive analytics over here. We can compare ARIMA to Prophet by using back testing. So we're predicting into the future what's going to happen next, and back test the event by going back in time. We're literally going back in time. That's why we have negative 10. This is stepping back 10 rows. We have the negative 10 right here. It's stepping back 10 rows to understand what happened in the past, and then compare that to the actual event. So we can actually manufacture time or simulate time right here, because we can go back in time and tell the model, okay, you make a prediction on what's going to happen next, but you don't know. But we actually went back in time 10 days. So you actually do have the actual events and the actual outcomes, and we can compare that to what should have happened. So we have the ARIMA, the mean average error, and the root mean square error over here. And Prophet, we have the same, so we're calculating the same over here. So the mean average error is using the average prediction. We're off by 1.32%. So pretty tight. That's pretty decent, pretty tight. And by Prophet, 1.39%. So I said Prophet was my favorite tool to use over ARIMA. Really depends on basic time series analysis like stocks or weather patterns or something like that. Sales forecasting, ARIMA does very well. Prophet does very well. If you have a more complex data set, I think Prophet outperforms ARIMA or S-ARIMA, which is seasonally adjusted ARIMA. That's what I've seen in my experience. But both are pretty good. Like, it's off by 1.32%. Not bad, right? It's pretty decent. It's pretty tight, pretty crisp. This is off by 1.39%. Let's look at this example right here. Control Enter. And I'm going to share all this code with you guys, by the way. Okay, so you don't have to be taking notes in your notebook or trying to memorize or internalize this stuff. I'm going to share all the code with you, so you can just download the code sample and copy and paste it into your own Jupyter notebook. You can easily convert a Jupyter notebook into, I say, well, everything is an HTML file. You can easily convert an HTML file into a Jupyter notebook if you want to do that. I think the reason I do that, some people ask me, why do you do that? Because it's a little bit more interactive. It's easy to share. You can't really see a Jupyter notebook until you load it. The HTML file is just a web page. You load the web page, okay, and if you want to convert the web page into a Jupyter notebook, that's one line of code. That's easy to do. Google it. I'm not going to do that right now. Just Google it. It's very easy. But I think if you copy and paste from HTML into Jupyter, it's a little more interactive and it forces people to learn a little bit better. If I just load this file into Jupyter and you just run it, are you really learning? Well, maybe, but maybe not. Maybe you're just going through the example and you're not really understanding how everything works. I think at least if you copy and paste, you get more out of it than if you just click the button and it just runs and that's it. Okay, so here's think this is one of the last examples or next to last. So here's the actual movement over time. This is the ARIMA forecast, and the profit forecasts are off by 0.02%. Here it's a fraction of 1% up and down. So you can see these models are doing a good, this is a good example of making predictions into the future, what will happen next. It's off by a little bit, right? This one is saying 0, this one's saying 2%, you're off by 2%. It's not a big deal, 2% up or down. Look at everything reverts to the mean and the long term. Okay, you can see the mean is the average, we're right around 0. And this stock chart up and down bouncing a little bit is pretty representative. You see the actual and the forecast of agreement and profit is pretty much similar. So we're taking the highs and lows and just balancing that out. That's how these things work. So let's look at one more example of predictive statistics. This is linear regression, and we're looking at Apple in this case, and we're trying to predict the beta series over time. Again, beta is the relative change of the stock price to the stock market. How volatile is this stock to the overall market? So if the market has an impact, how does that affect the stock? Or if the stock has a change, how does that affect the market, right? So there's a bigger effect on the market than the stock. The stock is just 1/500th of the market, presumably. That's the S&P 500. Okay, so the stock can move up and down more than the market can, but they're all going to be co-integrated. Okay, and this is the last example here, and we're looking at, again, predictive statistics, and we're trying to forecast into the future what is going to be a change in this one stock. Apple shifting with a 1-day lag or shifting with a 2-day lag, and we're looking at the volatility over 5 days. So we're looking at 5 days and the shift 1 day or 2 day, and with 84.5% accuracy. So R squared measures the goodness of fit 84.5% of the time. We can measure the future movement of the stock based on this model right here. This is a basic linear regression model. Oh no, I'm sorry, this is random forest regressor. So a little bit more sophisticated than the linear regressor, but they're pretty similar. So 84.5% of the time we can predict the outcome of the stock or the movement of the stock up and down based on the historical movement of the stock with pretty fine precision accuracy, 84.5%. So that's it, guys. That's the whole lesson for today. That's descriptive, diagnostic, prescriptive, and predictive statistics applied to finance. There's so many applications for this. Again, like automotive, aviation, government, nonprofit, education. There's so many applications. You have to take your own data set, dump it into these models, and then see what the outcome is. If you have questions or recommendations for future teaching lessons, just let me know. Put that in the comments. I'm going to wrap it up right now, and I will see you in the next one. Thanks. Bye.